Financial concepts. Welcome back, everyone. In this session, we are going to talk about some very important financial concepts. These are the ideas that every manager and business owner needs to understand. When you know these concepts, you can read financial reports more easily, and you can make smarter decisions for the business. Business structures. Let's begin with business structures. There are different ways to set up a business. The first is a sole trader. This means one person owns and controls the business. It is simple and easy to start, but the owner carries all the responsibility. The second type is a partnership. This means two or more people share the work, share the risks, and also share the profits. And the third type is a company. A company is different because it is a separate legal business. This means the company has its own identity and it is separate from the owners. This can help reduce the personal risk for the owners. Financial statements. Now let's look at financial statements. Financial statements are reports that show the money situation of a business. They answer important questions like, is the business making a profit or is it making a loss? What things does the business own? And how much money does it owe? And what is the income and what are the expenses? Managers use these reports to see how healthy the business is and to decide what actions they need to take. Balance sheet. The balance sheet is one of the key financial statements. It shows the business at a single point in time, almost like taking a photo of its financial position. It has three parts. First, assets. These are things the business owns, like cash in the bank, stock on the shelves, or equipment in the office. Second, liabilities. These are the debts or money the business must pay, like loans or bills. And third, owner's equity. This is the owner's share of the business after all debts have been paid. There is a simple formula you should remember. Assets equal liabilities plus owner's equity. This formula always stays in balance, which is why it is called a balance sheet. Profit and loss statement. The profit and loss statement is another important report. Unlike the balance sheet, which shows just one moment, the profit and loss statement looks at a period of time, such as a month or a year. It records revenue, which is the money the business earns, and expenses, which is the money the business spends to keep running. When revenue is higher than expenses, the result is a profit. But if expenses are higher than revenue, the result is a loss. This report helps managers and owners understand if the business is performing well or if it needs to make changes. Assets, liabilities, and owner's equity. Let's take a closer look at assets, liabilities, and owner's equity. Assets are resources the business owns. They can be things like cash, stock, machines, or even buildings. Liabilities are the opposite. They are debts or obligations that the business must pay. This can include bank loans, unpaid bills, or money owed to suppliers. Owner's equity is what is left for the owner after the liabilities are paid. You can think of it as the owner's value or share in the business. Revenue and expenses. Now, let's talk about revenue and expenses. Revenue is all the money that comes into the business from selling products or services. For example, if you run a cafe, revenue is the money from selling coffee and food. Expenses are all the costs of running the business, such as paying rent for the shop, wages for staff, or buying supplies. If the revenue is bigger than the expenses, the business makes a profit. But if the expenses are bigger than the revenue, the business has a loss. Chart of accounts, journals, and ledgers. Every business needs to keep records of its money activities. This is done through a chart of accounts, journals, and ledgers. The chart of accounts is a complete list of all the accounts the business uses, like cash, sales, rent, and wages. The journal is like a daily diary where every transaction is written down. The ledger is where these transactions are grouped into categories, so it's easier to see the totals. And we must also follow the double entry rule. This rule says that every transaction has two sides, a debit and a credit. This keeps the records balanced. Taxation, GST, and BAS. Now, let's move to taxation. Businesses must pay taxes to the government. There is a special tax called GST, or Goods and Services Tax. This is a tax added to most goods and services. Businesses also need to complete a report called the Business Activity Statement, or BAS. This report is sent to the government and shows GST, taxes, and other payments the business must make. Budgets, budget consultation, and negotiation. Finally, let's look at budgets. A budget is a financial plan for the future. It shows how much income the business expects to earn and how much it plans to spend. But budgets are not made alone. Budget consultation means discussing the plan with other people in the business so everyone understands and agrees. Sometimes this involves negotiation, which is talking with others to reach an agreement. For example, a manager may need to negotiate with a department about how much money they can spend next year. That brings us to the end of this lesson on financial concepts. Today we looked at business structures, financial statements, balance sheets, profit and loss reports, assets and liabilities, revenue and expenses, accounting records, taxation, and budgets. Thank you for joining this session. I hope this helps you build a clear understanding of these important financial basics.